The broadcast is now starting. All attendees are in listen-only mode.
Hi everybody, this is Manoj Abhichandani, and today I'll be presenting on auditor's duty of care. Sorry for starting the webinar a couple of minutes late, but we'll get on to it, and today it's going to be a short one, probably about only half an hour, and then we can have some question time. Those who have never attended my presentation before, just to let you know that I've been in the SMSF space for almost 30 odd years, and I used to run my own practice, and I was the nominated auditor for a CPA 3-partner firm for about 600 odd funds for about 19 odd years. Now, I've also written the online SMSF audit software to help other auditors audit. Um, uh, it's been quite useful for other auditors, and as you can see, about 80,000 plus funds have been audited. Now I believe there are more than 1,000 auditors using the software. Now, just before I begin, just some housekeeping issues. We're going to talk about how you can change your engagement letter so that you can restrict what you are auditing and how much you are auditing. The second thing what you should be looking at is when you're auditing a fund, when you look at the funds where your clients, your super fund clients have invested, whether they are custodians or they are investments in unlisted companies or unit trusts or syndicates, how you audit them, how you value them, and whether there is any potential risk of trustees actually claiming against you in the future. Uh, Now, before I get into it in detail, just want to talk about some housekeeping issues. Now, I hope all of you can hear me. I can recollect last week we had a problem and had to restart the presentation, but I guess if you can't hear me, this is the best I can do. There's a phone number on your panel. You can try ringing that number and perhaps you can hear me better then. You'll see that I have uploaded two handouts, and one is the presentation and the second handout is a recommended change in your trustee representation letter, your management letter, and the engagement letter, and I'm going to talk about that once we get to it. But feel free to download these two handouts from your panel. I'll just present, I'll just speak for about 20-30 minutes, and then I'll be open to your questions. Um, I'm sure there'll be quite a few because the way I have been researching this case and this topic, I'm sure there'll be a lot of queries from all of you. Before I begin, just to let you know that this presentation is only for educational purposes and it's not any legal advice on how you should conduct your business as an auditor. Now, in a nutshell, this case, I was able to uh, go through the initial case and then the appeal, and I thought that this was more to do with trust and friendship. Because what happened is the trustee of the super fund trusted a very good friend and to look after the trust money, and the person who was looking after the money for the trustee of the super fund, he did not inform the trustee that that there were problems in the investments, and the trustee of the super fund continued to make further contributions into the fund, and the friend did not inform the trustee. So it's more of a case of broken trust, and a friend not looking after another friend. And I'm going to talk about it a bit more in the next slide. But that's what I think what it was, because um, there was an investment made by a super fund, and that investment was actually lent to the custodian's entity, and the custodian's entity was not performing well. And this is during the GFCA period, and they lost money. And in the meantime, there was a set of accounts prepared, and the auditor audited it, and there's a negligence case because the auditor did not discover that these monies were not recoverable and did not report it to the trustees, and hence was found negligent. But what is very important in this case is it's not that the auditor who was negligent, but it is also the trustee who had a very low sophistication as far as investments are concerned. He relied on the audit report, and because of his reliance and his low level of financial sophistication, on appeal, the judges found that was the cause of the damage. Had the trustee been informed by the auditor that there is a problem, the trustee would have taken action to recover the monies from the custodian who was looking after the super fund's money. So we're going to talk about that a little bit more. Now, I'm also going to discuss limitations of audit, your engagement letter, uh, what what you are actually auditing, how are you being engaged, what is the scope of your audit, and why are you looking after, or why are you engaging yourself, and why are you being hired in the first place. So all those things need to be spelled out, and in this case, I could not find anywhere where the auditor had actually issued an engagement letter to the trustee of the fund. Now, as an auditor, we see very funny types of investments by super funds. I mean, investments in horse syndicates, investments in whiskey barrels, and things like that. So, valuation is a big issue. But a bigger issue is that whether those assets are recoverable or not. Now, some of those assets are unlisted trusts and companies, and sometimes monies are handed over to unrelated parties, but they are custodians. They are like syndicates, and perhaps the only thing which the super fund owns is a piece of paper to claim that it's a unit in some sort of a unit trust. So, as an auditor, your job is to not only substantiate whether that asset actually is held by the super fund, but also to verify whether that asset is recoverable, because it's sitting on certain value in the balance sheet, and whether that value is correct or not. Now, that value determines the member balance, and if the member decides to retire or take a lump sum, he should be able to do so, because that is what the auditor believes is recoverable. Now, in this case, the investment was described as cash in a certain entity in the balance sheet, and the problem was that it was not recoverable, and that cash was still in the balance sheet, and the auditor did not qualify his audit report, and also in my reading of the case and its appeal, I did not find whether the auditor actually wrote a management letter as well. So this is where the auditor went wrong as well. There was no mention of any engagement letter, and there was no mention of a management letter. So it's not necessary um, for the auditor to actually qualify the audit report. What he could have done is he could have alerted the trustee of the recoverability of the investments in a management letter, which was also lacking. So basically, there was a lack of communication between the auditor and the trustee. So in round one, it was decided in favor of the auditor because the judge said that what was the likelihood of the trustee taking any preventive action had the auditor warned them. Uh, the judge interviewed or took evidence of the trustee, and he asked them a question that at the moment it says cash with such and such company, but had it said loan with such and such company, would you have changed your behavior with the custodian? And in that case, the trustee said that he would have not. So he would have not taken any action. So it was literally not cash. So had the auditor even alerted the trustee, what action would have the trustee taken? So the judge came to the conclusion that there would have been no change in trustee behavior. Hence, the appeal was dismissed, and the auditor was not liable for any damages, although the judge found him to be negligent in performing his audit and not doing his job properly, and not not doing all of those things which an auditor needs to do, and um, was not he was not fulfilling his duties completely. Now, in round two, the trustees appealed, and the three judges found the auditor to be negligent. At the same time, because of that negligence, it caused the damage because the trustees continued to make contributions into the fund between 2003 and 2007. And the argument was that had they been alerted by the auditor, then they would have not made further contributions into the fund, and that money would have not totally been lost. So let's look at the case as far as negligence is concerned. The auditor's duties are concerned. These are the issues which the judges found, that the auditor should review the superfund's financial statements. They should obtain evidence of assets, and this is where the auditor lacked in his duty. And then the next one was valuation of investments, and the auditor should have actually looked at that investment or cash in that unlisted company, and looked into the profit and loss and balance sheet of that company to determine whether that cash is actually sitting in that company, in that unlisted company. And then whether the set of accounts, the financial statements are properly prepared, and whether the notes of the accounts properly classify that asset as cash. And the definition of cash was discussed quite a bit. In this case, the trustees brought in a specialist, and so did the defendant, the auditor, and they both concluded that the auditor did not obtain sufficient evidence to conclude that the valuation of the asset in the balance sheet was correct or not. Now, there was lack of appropriate reporting. There was no management letters written, and the audit report was unqualified, issued by the auditor. So that's where the problems were. Now, just to understand the case, this Lance Beer, um, doctor, he's a dermatologist, and his wife. There's very little mention of Jennifer Campbell speaking up. So this is, and she was not even interviewed by any of the judges. So I think she had very little role to play besides being a director of the trustee company. Um, there was a change of the trustee company, but that did not change the whole. Uh, I mean, it was never brought into any discussion. Superfund was established in 1985, and the doctor got very busy. He had a very good friend, and the friend had a investment business, um, and the Superfund entered into a management agreement with Anthony Lewis. And Anthony and Lance were very good friends. They used to, I mean, in the first case, has been mentioned that they used to go out for movies together. They holiday to US together. They went out for dinners together. So they were very good friends. So um, uh, there was a very good um, uh, relationship between the two, and they used to live very close to each other and visit each other's homes quite often. And um, and Mr. Lewis knew that his entity, he owned quite a few entities, and one of those entities was LSL Holdings Pty Limited, and the management agreement actually allowed uh, LSL Holdings to uh, receive all the cash from the self-managed super fund and invest thereon and charge a fee for that work. Now, Anthony also owned an administration company, an accounting company with another person, and his share was 35%. So the set of accounts were actually prepared by an independent entity where Anthony Lewis was also a shareholder, and that accounting company actually engaged John McGoldrick, who was the Superfund auditor, and um, the first case details his qualifications, his experience in self-managed Superfund, and he was quite capable to actually audit the fund. Just to remind you that ASIC came into the picture on 1st of July 2013. Um, this case is a bit older because the audit was conducted for the Superfund between 2003 and 2007. So the financial statements of the Superfund showed cash dash LSL Holdings Proprietary Limited, Lance, and it had a figure. Um, the figure is close to $1 million, so it's not the figure which is important, but it's the cause of the damage which is important in this case. And for Jennifer's money, it showed cash, LSL Holdings Proprietary Limited, and in brackets it had Jenny. So LSL Holdings Proprietary Limited uh, was in control of Anthony Lewis, and LSL Holdings or Lewis Securities was actually charging a fee. So the contention is that it was actually not cash, but the super fund had actually lent money unsecured to LSL Holdings Proprietary Limited. So one thing also in this case I noticed, and in appeal, that the management agreement which was signed by the Superfund and Lewis Securities was not detailed. and that engagement on what must happen and how Anthony Lewis gets control and what level of control does he get was never discussed. And this is something I think we might get into round three, and perhaps John, the auditor, should think of appealing again in a higher court and try and get it overturned. But this is something which we'll discuss a bit later. Now, facts of the case were the investments were managed by a custodian who partly owned the accounting firm. The cash stayed in the balance sheet was investment as cash in the balance sheet, and cash was in fact a loan to a related party. And LSL Holdings Proprietary Limited did not have any bank account. All their investments were off balance sheet items, and in fact their liabilities were greater than assets in sometime in 2008. Now, the doctor wanted to set up a accounting practice, and he found out in 2008 that there was no money. And later on, Lewis Securities got into problems in GFC, and all the money, all his entities got liquidated, and he was not able to recover. So the damage was literally 100% of the superfund balance. Now, in the first round, when the doctor could not recover any of the monies in 2008, he appealed against the auditor, and it went over 7 days, and the judge found that the auditor owed the trustee of the superfund a duty of care. He should have qualified the financial statements, and the auditor should have made proper inquiries on the financial condition of Mr. Lewis Investments Companies. And it concluded that had the auditor made proper inquiries, he would have found out that there was a problem, and he should have informed the trustees of the superfund, which he did not. And he issued unqualified audit reports. So the judge found that the auditor had made false and misleading statements, and there was a breach in his duty of care. However, the judge found that although there was a breach of duty of care, those breaches were not significant enough, and they were not the cause of the actual loss. The judge found that there was a relationship between the trustee and Lewis and Anthony Lewis, and he should have been aware of the situation of how the investments are, because it is absolutely the trustee's responsibility to be responsible for any investment decisions. So the case was dismissed, and basically the auditor, John, walked away scot-free. But later on, in round two, the appellant, which was the trustee of the superfund, picked up a few points, and there were three judges. It's a Supreme Court. It was a Supreme Court matter. And what they decided is that the auditor actually failed in his duty to qualify his audit report and identify any potential risk. So what they thought, what the trustees thought, what the judges thought was, by looking at the audited statements, what they thought was that they actually have cash and shares. And because the auditor did not qualify, the auditor did not alert them of any issues, and did not tell them that it's actually an unsecured product, because in the balance sheet it said cash. The trustee continued to make contributions, And had they been alerted and had they been told that it's an unsecured loan to an entity, they would have not made any further contributions into the fund. Another factor which, on appeal, the judges found that the trustees actually relied on the audited accounts and on asking Mr. Lewis on how the fund was going. Uh, Anthony Lewis replied to Lance Beer and said, "It's an audited entity, and you have nothing to worry about." So the trustee's reliance, because he was a little bit unsophisticated investor, so the trustee's reliance was quite heavy on the audited accounts, and he had actually, in his mind, thought that he has hired the auditor to look after his assets. And that's where the duty of care comes in, and that's where the cause of the loss comes in. And because he relied and he was trusting the auditor to inform him of any wrong happenings or wrongdoings, uh, and uh, and the judges found that the majority of the loss is with the auditor. Um, uh, it apportioned 90% of the loss to the auditor, and the 10% loss was with the trustee of the actual loss. So, in conclusion, what we make out of this case is that the auditor actually owes a duty of care to ensure the accounts are correctly classified. If it says cash, should be cash. If it says shares, the shares must be present, and the valuation should be correct to the recoverable amount. Now, I'm going to talk about the recoverable amount because you don't, as an auditor, sign the audit report on 30th of June. You always audit sometimes later. So let's say um, set of accounts are done on 30th of June. You get a set of accounts sometime in September. You sign off the audit report in sometime in October. So when you're signing off the audit report, you're signing off an amount which was present on 30th of June. And this is something which I've noticed the auditors do not do. They don't look at the valuation of the assets at the sign off date. And last week we discussed cryptocurrencies because their valuations fluctuates quite a fair bit. Now let's also discuss property, because we have noticed in the last 5 years in cities like Sydney and Melbourne, properties have gone up by 75%. Now those properties were valued at certain value on 30th of June, and if you are auditing sometime now in August, or say in March 2019, that is 9 months later, are those property values still holding good on 30th of June 2018? That is the question which the auditor should be thinking before issuing an unqualified audit report. Now, what was also found that there were not significant investigation. All the auditor did was he spoke to Mr. Lewis, and Mr. Lewis assured him that everything is fine, and the auditor kept to that, and he did not request Lewis for a set of accounts of LSL Holdings. Had John, the auditor, seen the set of accounts of LSL Holdings, he would have been aware that the company is in trouble, and then he would have alerted the trustees of the super fund. Because he did not make um, uh, uh, sufficient investigation, he did not collect enough audit evidence, his audit conclusion was incorrect, and that is where there was a lack of duty, and that is where the work was negligent, and that is why there was a misrepresentation of the set of accounts, the figures in the set of accounts. Now, because an unqualified audit report was issued, the trustees believed that all was okay. So this leads us to what is the scope of auditor's duty? Who defines it, or what defines it? We are all aware that before we get engaged, before we start a job, we must have an engagement letter. And I think this is where John, the auditor, missed the point. There's no reference of any engagement letter in any of the two cases, the initial case and the appeal case. And once the engagement letter is established, your scope is established, and then there could be a talk of breach of duties, because all the duties are then listed in the engagement letter. And then we can talk about what is the breach of duty and what loss can be claimed by the trustees. It's very clear that trustees did not understand this investment, and they did not talk about the management agreement on the responsibility which the trustees were handing to the custodian. So this is something which is very, very important for auditors going forward, that if they see any item which is an asset of the fund, they should be first of all thinking whether that amount is recoverable, whether it can be converted back into those dollars at a later date or not. We are all aware that our audit report has to be according to the ATO guidelines, and the audit report has got two parts, the financial report and the compliance report. So the auditor's duty is not only to report on any compliance issues, but also to read any material misstatements in the balance sheet and the profit and loss account. The material misstatement which this case discusses is basically the valuation of the asset, and the error was there, and the notes of the account said that these amounts are recoverable and they are held as cash. So it's also the classification of the asset, whether they are immediately available or not. Now, I have found some funds where trustees invest in some syndicates, and sometimes those amounts are not recoverable in the near future, because the syndicate is going to go through a whole DA and a construction process. So if the money is locked away for a certain period of time, I think it should be the auditor's duty to actually report that to the trustee, although you would assume that the trustee would be aware of it uh, at the time of making that investment. But what this case does is actually expands the auditor's duty. Now, I'm not only alerting the auditors to be careful, I'm also alerting the accountants and the administrators to be careful, because John, the auditor, was trying to distribute the responsibility and the presentation of accounts as cash to the accountant as well. So in future, I think accountants can also be held liable. And again, we have noticed that many accountants prefer incompetent auditor, and I'm not going to define what an incompetent auditor is and what a competent auditor is, because in the eyes of ASIC, everybody who's an ASIC registered auditor has the same level of competence, which I do not agree to, because I've met auditors who know 10%, and I know auditors who know 50% of the law, of superannuation law, and I know auditors who know close to 100% of super law. Whereas the preference by accountant is that we need an auditor who does not ask for too many things, and we get the audit report without much of fuss and without uh, providing much of information, and we work through the audit process as a tick instead of a process which is actually a statutory requirement by legislation, by Superannuation Act, by SIS Act. The accountants should also be careful as far as evaluation of unlisted investments, um, substantiation and providing that evidence to the auditor. Most accountants put a disclaimer, it's in the financial statements, and they have a compilation report at the end. Uh, but times have changed, accounts get prepared nowadays by machines and not much by humans, although um, humans do have a part to play, but most of the work is done now by data feeds. Now, I talk about cryptocurrencies again because last year I noticed that there were quite a few funds who were created specifically for investments in cryptocurrencies. So this is something which you should be very careful of. And I think, in my opinion, if you are an auditor of a super fund which has invested in cryptocurrencies, your management letter, or if you decide not to qualify the audit report, at least in your management letter, you must mention that zero amounts are recoverable because of the fraud and the risk of the investment. So this is something which each auditor needs to decide on his own on how he's going to tackle those sort of investments. Then there are those investments which are loans to unrelated parties. Let's say a super fund lends to a friend or a friend's entity. Now, what is the probability, because it's an unsecured loan, what is the probability of recovering that money? In my eyes, if I'm the auditor, the chance of recoverability to an unsecured loan is zero. So what should be the balance in the balance sheet? I think zero. And if it is any other figure than zero, then the auditor has a weapon. Actually, he has two weapons. One weapon is the audit report. He can qualify the audit report, and the second letter is the management letter, and he can inform the trustees that in his opinion the recoverability is zero, and then mitigate his own risk for any future litigation or claims from the trustees that they were not alerted of any future loss. Now, what is the crux? Like, what do we get out of the case? One is negligence. Negligence in failing to identify and report any doubts as to recoverability of assets. So this is of paramount importance to all auditors, I would say, at this point of time. If you're negligent, you will pay. And how will you not be negligent? That means you have to spend the time, and if you see any investments which are unusual investments, which are unlisted assets like or property, for example, I've noticed many auditors do not even do a title search if the super fund owns a property every year. It's quite possible that last year you audited a fund, but this year when you're auditing, maybe the property is sold and the cash has been pocketed by the trustee. So whether that asset exists, number one, and the second effect is that what is the value, what is the recoverability of that asset. Now, in one of the hearings, John, the auditor, Mr. Lewis actually led him to believe that the trustees are happy with the fund's financial reports describing the monies in LSL Holdings account that way. And these are the words which Mr. Lewis told John. So what did John do? John trusted Lewis that 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 actually the trustees are happy the way the set of accounts look. Now, how can the trustee be happy? The trustee can be happy by actually signing the financial statements before your audit actually commences. And this is something which I've noticed, and I do presentations on CPD hours or CPD training to auditors, and constantly this question comes up from the group of all auditors: will they commence an audit when they receive unsigned financial statements from the accountant? And my opinion is, yes, you can commence your audit. There's no problem, because what they are is basically just a draft set of accounts. So there's no stoppage in issuing you in starting your work. You can commence your audit. There's no problem with that, but you cannot conclude your audit till you have received the final set of accounts. And what are the final set of accounts? The final set of accounts are um, the balance sheet signed, the profit and loss signed, and a minutes that by the trustees, signed by the trustees, that they are happy and they are aware that the accounts bear the correct valuation and the classifications. So those minutes are very, very important for the auditor. Those signed financial statements are very, very important for the auditor before he issues the audit report. Now, it's quite possible that the accountant meets the trustee after the audit has been signed off by you and then sends it to you. But then it becomes very difficult for you to date your audit report after the financial report has been dated. So how can the audit report be issued on a certain date which is before the trustee has signed the financial statements? So it's really very important, because if that matter is taken to court, all of these minor little issues would be seriously contested, and it's quite possible that the auditor could lose out. In this case, I think had the financial statement presented to the auditor uh, were already signed, then the responsibility, and had the minutes been signed that the trustee is happy with the classification and the valuation, uh, there was no case. It was a no-brainer, because the trustee would have accepted his onus. Had there been engagement letter and the scope defined, it would again be a no-brainer. And had the management letter even insinuated that it is not the auditor's responsibility to measure the recoverability of any asset, then again there was no case. Because all of those things were absent, only then John, the auditor, was found negligent. So, what are we supposed to do? Are we supposed to, if we are an auditor, lose sleep that we have issued these audit reports, and all of these trustees who have lost 50% or more, and we have issued unqualified audit reports because we did not warn them in 2007 and 8 that they're going to lose money in 2009 and 10? Are we going to worry that all these trustees are all of a sudden going to wake up and then claim against us because we did not warn them that this is what is going to happen? I'm not sure about that. And perhaps some trustees might be considering to commence some legal proceedings against their auditors. That so this case may be the beginning and may not be the end. So how can auditors protect themselves? Communication is the key. Engagement letter is the key. And if you look at the handout which I have provided to you, you will notice that I've given you sample text uh, to the engagement letter, which you should incorporate. Now, if you're using online SMSF audit, we have four versions of it. Four versions of engagement letters, four versions of trustee representation letter, and four versions of management letter. So when you complete an audit, all these documents uh, get get created in the system, and that creates a extra triple layer to the work which you are doing. Um, in the email, I have mentioned to all auditors using the system, we cannot guarantee that putting these extra clauses, transferring the onus from the auditor to the trustee would be 100% safeguard, but at least it will create some sort of a layer of protection that your audit, your engagement was limited to a certain process, to a certain statutory requirement, and not to check whether the assets or whether the investments are recoverable or not by the trustees. The same way, we have amended the trustee representation letter, and what we have said is that the trustee is not passing that responsibility, uh, and actually limiting the scope of investment decisions to himself, and not burdening the auditor to actually judge whether the investment is suitable for the trustees' needs or not. And again, in the management letter, we have identified certain assets which have been which are actually made by the trustees, and we are trying to refrain from commenting whether those assets will actually hold good when trying to be converted by the trustees into cash. Introduce yourself to the trustees, that's very important. Phone calls, and whether the management letter has been cited by the trustee or not. Perhaps the following year you should request the accountant that you want a signed management letter, whether the trustee has actually gone through all your points or not. Now, in my today's presentation, I went through the two cases. I went through the relevant auditing standards. These are something which you should also go through. I have pointed them out. In the handout section, you will see that you can download my today's presentation and go through these relevant auditing standards. As you can see that um, by this case, our job has become a little bit more complicated, a little um, bit more detailed, and I think our responsibility has been extended. So I think you should look at seriously at some of the jobs which you have done in the past, and some of the jobs which you will be doing in the future, and be very, very careful on issuing unqualified audit reports. I'm now going to look at the questions some of you have put forward. I can see there are quite a few questions, but I'll try and answer quite as much as I can. Okay, the first question is from Lee. He says that why there is a financial inquiry on it was blatantly the financial planner's fault, not the auditor's fault. This is just a technicality to offload the problem to the auditor. The judges have a lot to answer for here. Like I said in the very beginning of my presentation, I mentioned that um, that it was, this case has more to do with trust and friendship, because in the first case, it was clearly demonstrated that Dr. Lance Beer was a very good friend of Anthony Lewis, and Anthony Lewis knew that there is a problem, and there was even mention that Lance Beer used to drive to Anthony Lewis's house to give him contributions every year. So every case, in every contribution, um, Anthony knew that this is an unsecured loan. He should have let his friend know about it. So you're absolutely right. It's just that the auditor got roped in because of technicality here. But I agree with you here at 100%. Next is a question from David. He says, auditors are generally not qualified to decide on recoverability of assets if an asset such as this loan is on hand and there are no breach of the loan terms, then its value is as stated. That is what is owed by the borrower. The borrower, as a private company, is under no obligation to provide its financial statements to the auditor. Yes, David, you're right. But in your working papers, I think you should at least write to the syndicate or to the borrower and say that, oh, you've borrowed this money. Do you intend to return it? And if you do intend to return it, how much do you intend to return it? Because I'm going to make a comment on it. So I guess what this case is doing is it's extending the responsibility of the auditor one step further. But like I said, that by limiting your engagement and mentioning in your management letter. Now, what should you mention in your management letter? I think you should mention everything. You should Is reporting everything as a non-recoverable the answer? And I think it is, because if you say you've got certain assets, let's say you've got Westpac Bank shares on 30th of June, and I'm auditing today, and the share has moved, say, 20 cents. But uh, but maybe a year later, Westpac Bank does ceases to exist. So what is the probability of recoverability of that asset that is a listed share? I think zero. So if you write in your management letter that yes, you have a balance sheet, yes, you have figures, but I think you'll recover nothing because nothing is recoverable. At least you're protected because you're telling the trustee that nothing is recoverable. And that is what we have tried to put in our management letter or online SMSF audit, to say that we cannot guarantee, because we are not trained as auditors to actually value these companies and find out that what the future value or the monies would be recoverable or not in the future. So I totally sympathize with John, and I think uh, we haven't heard the end of this, and I'm sure he would be taking it to a higher court. Okay, Michael says, we use audit staff overseas. Should this go in the engagement letter? Can we change in SMSF audit program? Look, if you're using staff overseas, the other day I was talking to an auditor. He was in Singapore on a holiday and he was auditing from Singapore. And I said, you're overseas. Have you told the trustee that I'm overseas and auditing from overseas? So it doesn't matter where your staff is. As far as online SMSF audit is concerned, all the data is in Brisbane. So in a server in Next DC, which is a listed company. So I'm not sure whether in your engagement letter it would be sufficient to say, or would it be required to say that some of my staff is overseas, so, or I am overseas at the time of audit. So I think, Michael, so I'll let you make a decision on that. So I'll just move on. The next question is from Sarah. She says, with regards to the auditor's need to review the value of SMSF assets, would it be more important to highlight the assets that have decreased in value rather than increased, or are both equally important? I think, Sarah, what is very important is when you're auditing on a date after 30th of June, let's say you're auditing today, let's say you're issuing an audit report today, uh, and I have mentioned it in my list of auditing standards. If you look at auditing standard 560, subsequent events, if there is a material drop in any asset value or a material increase in any asset value, I think at the time of signing the audit report, you should bring it to the accounts. So if the asset has dropped to a certain percentage, and that what is material is for each auditor to decide, and if you mention that in the in your it's not about qualifying the audit report, it's the financial report, the part A of the audit report. If you mention it there that I I agree or I don't agree, either one of them, usually you will find that the accountants will agree if you say to them that there's been a huge drop in a certain asset and your valuation, I don't agree to your valuation. So if you don't change your balance sheet, I'm going to I'm going to qualify my part A of the financial report. So I guess it's kind of a negotiation between yourself and the accountant, the administrator, and getting something right. Next question is from Mark. Are there new wordings on all funds in the portal? Yes, we have uploaded the new text on all the templates. So when you do your next audit, you will see that the text will appear there. And if you look at the reports tab, if you don't want that text or if you want to change that text, you can download the report, you can change it, and then you can upload the text, and the system will use your uploaded version. Now, this is an appeal to those auditors who are not using our system. Either they're using a manual system or they're using some other platform similar to online SMSF audit. My word of caution is good luck. Um, do something. And as a humanitarian, I have actually given you the contents which we are using, given you the text which we are using. It's up to you to use that text or something even stronger to protect yourself. But you are being warned. The next question is from Simon. He says, these investments are financial products which we cannot give advice on without AFS license. Is this a defense? Simon, what we are doing here is we are worried about, the trustees are worried about, in this case, about the classification, that is cash, whether it is cash or not, because it was a loan. So secondly, this case is about valuation of the asset on 30th of June. So this could be not a financial advice and investment decisions here. So this is a different matter. It's nothing to do with an AFSL license. The next question is from Anne Marie. She says, "Can you tell me where I can get to your slides, please?" Okay, Anne, if you can look at your panel, you can see there's a handout section. Um, you will see that there are two handouts there. One is a copy of my presentation, and one is the text of all the changes which we have made to the engagement letter, trustee representation letter, and the management letter. I'll take two more questions if you don't mind. I've gone beyond my time anyway. So next question is from Michelle. She says the auditor might not have a right to get the financials of the private company, but the trustee of the fund does, and the fund has 14 days to give them to the auditor. Good point. If the unlisted company refuses to give information, perhaps the auditor could request the trustee for that information before issuing the audit report. Good point, Michelle. I appreciate that point there. Next, and the last question I will take. Okay, Ken is. I'll take two more. Next question is from Nishant. He says a comment was made that an unsecured loan should have a carrying value of zero. Wouldn't you test other attendant factors such as regular servicing, installments being paid on time, loan agreement, etc.? Absent this, even bank balance is not recoverable, should have a carrying value of zero. Yes, Nishant, I totally agree with you that it is basically your judgment against my judgment. If I'm the auditor, if I'm going to protect myself, I'll say zero recoverable. If you think that it has a higher recoverable probability, then you could be right. But in today's world, if you had a bank account with Lehman Brothers, you would not agree with your comment, and you will say the money in the bank is there, but maybe it's not there. Um, so it's up to you on how you judge it. But if I was the auditor of the fund, I'll say nothing is recoverable. Even property values are fake, and these are just fabricated values, and could be wrong. So this is how far I will go to protect my auditor's license. Next question is from Ken. Could you please elaborate on the need for the accountant to prepare a compilation report? I think, Ken, if you look at your engagement letter as an accountant, you will find all CPAs will CPA Australia will provide you a sample. CA ANZ will also provide you with a sample engagement letter for an accountant. So you will see that basically a compilation report which comes out from most softwares is on those guidelines. I urge you to talk to your professional body. Okay, I've got Alan. He is a regular, so I'm going to answer his questions and then I'm going to close today's presentation. Okay, I've got two questions from Alan, and I'm going to take both of them, and that's it. So Alan says, is the engagement letter and your management letter according to the CPA and CA? Look, I'm not aware that CPA has provided an engagement letter or the management letter, but I am aware that GS 009, the guideline for auditing self-managed super fund, has a sample engagement letter and a management letter. So an engagement letter is per auditor. I would be seeking my CPA reviewer or CA reviewer to look at my engagement letter and find any faults in them, but I don't think I should be more worried. I should be worried about what the professional bodies have to say, because I, as an auditor, would like to protect my interest and my license first. So this is what I think. But if you're a member of CPA, I think you should approach them and get it clarified by them. One more point I would like to make is that GS 009 was updated in 2015, in September 2015, and it's the engagement letter and the management letter is quite old, and this is a recent case. So I would not be using the one which is on the GS 009. Next question Alan has got: if a third party provider's services are being used, that means a custodian, I guess here, this requires a specific client agreement. Therefore, if a super fund online is being used, this is meant to be disclosed along with the data is stored on the and the location on the server. Alan, if you look at the engagement letter, we have updated the engagement letter to disclose to the trustees that you are, as an auditor, using an online service, and the data is stored in a third party environment, and the third party is responsible of it. So please have a look at the trustee engagement letter. Sorry, please have a look at the Auditors engagement letter. Like I said, if you're not happy with the engagement letter, please write to me, and I will be very, very happy to update it. Okay, I have another question. Nick, I have 1 more minute. Compilation report is not always required if the accounts are audited. Nick, good luck. If you are an accountant, um, if I was the accountant, I will always put a compilation letter, because I am just compiling a set of accounts from information provided. So I guess you need to talk to your professional body about that. Okay, one last note before I end the presentation today. Um, uh, we auditors got together and created SMSF Auditors Association of Australia. I will be very soon having a presentation and introducing you to the website. Have a look. It's not 100% ready, but you can have a look at smsfaaa.com.au. So it's SMSF Auditors Association of Australia.com.au. So it's smsfaaa.com.au. It's not ready yet. It'll be ready very soon. And we will be requesting you to make submissions for the 3-year audit cycles very soon. To join the association would be only $10 a month plus GST, tax deductible, hopefully. You will be paying GST as well on top. And this is my appeal to all of you to get together and approach the Treasury jointly, and anybody making any point in that submission would be included in our joint submission. You're free to, as soon as the website is ready, which I'm hoping, because the bank account is still not open, the merchant side of it to collect payments by credit card, but we've been promised by Thursday or Friday that would be working. As soon as it's working, I will let everyone know that you can come in and join and put forward your points in the 3-year audit cycle submission, which the association would be lodging with the Treasury. I'm aware that the last day to lodge the submission is 31st of August. It took us a very long time to register the organization, and to set up the bank accounts and to create the website and things like that. But we are well on track, and I will be announcing and launching the website very, very soon. Thank you very much.